Technical analysis of the financial markets, John J. Murphy. Every chart you will ever open is a picture of people making decisions under pressure. And this is the book that taught generations of traders to read that picture. It remains the closest thing charting has to a standard reference, the one that trading desks still hand to newcomers in their first week. Core thesis. John Murphy's argument is that technical analysis is not a bag of indicators. It is a coherent method for reading the collective behavior of every market participant directly from price and volume. The technician does not need to know why a market is moving, because the market has already weighed every known fact, hope, and fear and expressed the verdict as a price. Studying price is studying the crowd, and crowds behave in recognizable, repeating ways. The whole edifice stands on three premises. Price discounts everything, so the news you are waiting for is already in the chart. Prices move in trends, and a trend in motion tends to persist, which is the entire reason charts have forecasting value. And history repeats because the patterns on a chart are pictures of human psychology, and greed, fear, and hope do not evolve on a trading timescale. Over all of it sits one governing attitude. The technician deals in probabilities, never prophecy, and the toolkit exists to tilt the odds and control the damage when they fail to pay. The oldest rule in the book, Murphy grounds everything in the observations of Charles Dow, made more than a century ago and still load-bearing. Markets move in tides, waves, and ripples at the same time. The primary tide defines the bull or bear market, the intermediate waves correct against it, and the daily ripples are mostly noise. The trader's job is to align with the tide and use the waves for timing. Dow's most durable tenet is about the burden of proof. A trend is assumed to remain in force until it gives a definite signal of reversal. Not a worrying headline, not a tired feeling, a definite signal. The amateur spends a career calling tops and paying for the privilege. The professional assumes continuation and makes the reversal prove itself in the structure of the chart. Osiris Capital Trading Desk carries the same burden of proof into every session. Its default red is the established direction, and a reversal has to earn its evidence in structure before the coaching will turn against the trend, because the most expensive habit on any chart is arguing with a move that has not finished. Levels, and what happens when they break. The working architecture of a chart is support and resistance. Support is a zone where buyers have repeatedly stopped a decline. Resistance is where sellers have capped an advance. And the levels hold power because markets remember. Everyone who fought at a price last time is watching it this time, and their memory makes the level real. Murphy's most useful single insight is row reversal. When support finally breaks, it does not vanish. It becomes resistance on the way back up, because the crowd trapped on the wrong side of the break is waiting to escape at the price that hurt them. Broken resistance becomes support by the same logic. A level's meaning flips the moment it fails, and the trader who understands the flip gets both a low-risk entry and a precise line in the sand. If price climbs back through the broken level, the premise is void, and the trade is cut without discussion. Patterns that end trends and patterns that pause them. Murphy sorts all chart formations into two families, and the sorting matters more than the names. Reversal patterns mark the end of a trend, continuation patterns mark a pause inside one. The head and shoulders is the archetype of the first family. Three peaks with the middle one highest, finished only when price breaks the line connecting the intervening lows. Volume tells you whether to believe it, fading through the three peaks as the buying quietly exhausts, then expanding on the break. The continuation family, the triangles, flags, and pennants, is the market catching its breath, and these usually resolve in the direction of the move that preceded them. The practical discipline is the same across every shape in both families. The pattern is not a trade until price completes it with a decisive break. The measured objective gives the winner room to run, and the far side of the pattern gives the loser a mechanical exit. Anticipating a pattern before it completes is not analysis. It is a bet against a trend that has not yet broken. Volume is the lie detector. Price shows what happened. Volume shows how much conviction was behind it, and the two must agree before a move deserves trust. The rule is that volume should expand with the trend and shrink on the reactions against it. A rally on thinning volume is running out of participants and warning you before price turns. A breakout on heavy volume means the crowd has committed. The same breakout on thin air is a trap wearing a costume, and passing on it is not a missed trade. It is the discipline working. Volume also marks the endings. The climactic surge after a long advance, when the last buyers finally rush in together, is exhaustion rather than strength. And the professional reads it as the trend spending its final fuel while the crowd celebrates. Averages follow, and that is the point. Murphy is precise about what a moving average is. It smooths the noise of individual bars into a visible direction, and because it is built from past prices it always lagged, he treats the lag as the honest price of confirmation rather than a flaw. The average will never catch the exact turn, and a trader following it gives back a slice at every top. In exchange, it keeps you on the right side of the fat middle of every trend, which is where the money actually lives. The classic signals, price crossing its average or a faster average crossing a slower one, are trend following by construction. They lose small, and often in sideways chop, and win large and rarely in trends. And the trader who cannot accept that shape of results will abandon the tool at exactly the wrong moment. Oscillators and the warning called divergence. Where averages follow the trend, oscillators read its pulse, measuring how stretched a move has become. Murphy's two warnings here are the ones amateurs ignore at the greatest cost. First, overbought is a condition and not a command. In a powerful uptrend, the oscillator can sit at its ceiling for weeks while price keeps climbing, and shorting a strong market, because a number says stretched is a way to get run over by the very trend you are supposed to follow. Second, the genuinely valuable signal is divergence. When price grinds to a new high but the oscillator prints a lower high, the force under the move is fading even though the move continues. It is one of the few honest early warnings a chart gives, and it is a warning, not a trigger. Osiris Desk treats it exactly that way in its coaching, as a reason to tighten and protect what a winner has earned, never as a license to flip against a trend that price itself has not yet broken. No market is an island. The book's signature contribution is intermarket analysis, the recognition that currencies, commodities, bonds, and stocks move as a connected system. A falling currency lifts commodity prices. Rising commodities press interest rates higher and bond prices lower. The cost of money eventually governs equities. So the bond market has a habit of leading the stock market at the turns. The correlations shift with the regime. And Murphy's point is not that the linkages are fixed, but that the question must always be asked. What are the other three markets saying about the one in front of you? For the trader, this is context, and context grades conviction. A technically clean setup leaning into a macro headwind is a lower odds version of the same trade, to be sized down or skipped. And when the wider alignment and the local setup disagree, the discipline default is to stand aside. The rules that outrank the analysis. Murphy closes where every honest technician ends up. The best analysis in the world is worthless without money management, and he ranks the unglamorous rules above the entire toolkit. Trade with the trend, cut losses short and let profits run. Protect every position with a stop, so no single trade can matter much. Demand meaningfully more reward than risk before entering, and hold the risk on any one position to a small fraction of capital, because losing streaks are not a possibility, they are a schedule. Underneath the rules sits the book's real philosophy. No pattern, no indicator, and no relationship is ever certain. Each one only tilts the odds. The technician's edge is not foresight, but process. A positive expectancy repeated mechanically across many trades until the statistics assert themselves, held steady through the losing runs that any honest method produces. Bottom line, this book earned its place as the standard reference because it is both encyclopedic and coherent. It starts with why price is worth reading at all, builds the full grammar of trend, level, pattern, volume, and indicator, and then widens the lens until every market is read in the light of the others. Its lasting lesson is not any single tool. It is the attitude that runs through all of them. Markets trend, crowds repeat, the trader aligns with the probable, and discipline handles the improbable. Talent rarely decides whether a trading career survives. Far more often, it comes down to whether principles like these survive the first real drawdown. Osiris' desk exists to help a trader survive precisely the drawdown, an advanced platform for trader development and disciplined trade management, and the flagship of Osiris Capital. That survival is not left to chance, because Osiris Desk studies this very book as closely as it studies every level on the chart. It keeps the burden of proof on the reversal, respects what a level means before and after it breaks, and treats every signal as a probability to be managed rather than a prophecy to be believed, until Murphy's grammar of the chart is simply how you trade.